Let's look at the format of the income statement. We'll start with our revenues. We'll take away what's called cost of goods sold. That'll give us what's called our gross profit. So that's not net profit, that's a different type of profit which we'll look at. We take away any stock gain or loss. So from chapter 9 we figured out stock gains and losses, and that'll give us what's called an adjusted gross profit. Then we take away our other expenses, and that'll give us our net profit. So looking at that as an example, we start with revenues at the top. So take away our cost of goods sold. So we've got $22,000 of revenue, cost of goods sold of $14,000. That equals a gross profit of $8. Take away any stock gain or loss. So in this case, we've got a stock loss of $500. That'll give us what's called an adjusted gross profit of $7,500. Then there's our other expenses. So we've got rent and wages. So the reason we use other expenses is because there's actually already some expenses up here called cost of sales and cartage inwards. They're just what's called a cost of goods sold. So we still have other expenses, and that's why we use that title. That'll finally give us our net profit. So you can see our net profit was $2,500. This is called a classified income statement. So just like we had a classified balance sheet, which was current and non-current, this means an income statement with much more detail than just revenue less expenses equals net profit. You can see it's got several sections, and that's called a classified income statement. And what it helps, or what it does, is calculate three types of profit. You've got gross profit, adjusted gross profit, and net profit. There's a link between the owner's equity section of the balance sheet and the income statement. So we learned in the last chapter, owner's equity section is going to be a little bit different. We'll start with opening capital, and then what we'll do is add in any profit or loss. And that's where there's actually a relationship with the income statement. So the figure there must match whatever was in your income statement. So if net profit was $2,500, that goes and increases your capital, which gives us total possible capital of $122,500. And we also learned in chapter 10 we need to take out drawings, in this case of $13,000, and that'll give us a final capital balance.